In this video, I'm going to summarize as briefly as possible our investment philosophy and why it often feels like we're swimming upstream relative to most of the financial world. This is the necessary disclaimer that says I'm doing the best I can, but I'm not giving any advice. All right, when we invest, we're putting money that we've saved at risk, and therefore it would seem to be wise to know why we're doing it. First, though, we need to define what we mean by risk, and I'm defining risk as making less of a return than you need to accomplish goals. Another way to say that is not having enough money when you need it, which can happen by having either too many setbacks or not getting the returns that we've come to expect from history. At the risk of oversimplifying, I'm going to say that there are two main purposes for investing. You're either concerned with maximizing your return, or you want to preserve the buying power of what you saved and grow it at a reasonable rate. Maximizing return is a phrase used all the time in financial planning circles, and it's by far the most common. And portfolios designed for this typically get their growth from stocks, so the benchmark tends to be something tied to the stock market. And some combination of stocks, bonds, and cash is considered optimal for your risk tolerance, whatever that means. In the financial world, we call that optimal combination the efficient frontier. The reason stocks are used to maximize return is because historically, stocks have done the job pretty well, and we expect that to continue indefinitely. So if we ignore the disclaimers that tell us that history is not a reliable indicator of future returns, we can comfortably invest in stocks, but we do need to be truthful in admitting that we don't really know what the ultimate return will be. And remember, not getting a sufficient return is one of the risks, probably the primary risk. Let's contrast that with an investment goal of protecting buying power against inflation and growing it at a reasonable rate, or maybe using your portfolio as a cash flow machine in retirement. In this case, we can have a very specific return that we're trying to hit. Protecting buying power usually means limiting losses, and to do any more than just paying lip service to risk management means you have to look beyond just publicly traded stocks and bonds. This branch of the investing tree doesn't rely as much on history repeating itself as it does the downside protection and predictable returns that are built into a lot of the investments. In order to have some control over returns and losses, the returns in this style of investing are often defined or deterministic. One of the biggest differences in these two approaches is how success is measured. If the goal is to maximize returns, we typically judge success on whether we beat something else we could have done. But that benchmark rarely ties in directly to our specific financial goals. Having a defined return target, on the other hand, gives a very clear measure of success. It's really simply, am I ahead or behind? Now, the good news is that a portfolio doesn't need to be all of one or the other, although the left side is more popular because it's part of the investment entertainment industry. Maximizing the upside through the use of stocks or stock funds means you're exposing a portfolio to more downside, which results in a wide range of returns, good and bad. The reason stocks are popular for maximizing return is that their price is ultimately determined by investor emotion, and that means their price can go up much more than the economy or an individual company's business conditions might dictate. Price of Ford stock right now is 12 and a half times its annual earnings. AMD stock is 246 times its annual earnings. And why is that? Well, it's because more people want to own AMD stock. The primary risk reduction method for stocks is diversification, or owning different types of stocks that don't all behave the same. If they tend to behave the same over time, we say they have a high correlation, and we can measure that. The mutual fund industry has been very helpful by coming up with literally thousands of different funds that allow us to easily diversify between big and small companies, US and foreign, something we call growth and value stocks, although the definition of those keeps changing. Harry Markowitz has a famous quote where he said, "Diversification is the only free lunch in investing." So to see how well this works, I ran correlation reports on the major stock types over 3, 5, 7, and 10 years. They all said pretty much the same thing, so I'm just going to show 5-year numbers. And according to Morningstar, any correlation value above 75% means there's no meaningful diversification. A value of 0% means that two investments have absolutely no correlation, and that would be the ideal. So let's start with the S&P 500, which is the collective stocks of 500 large US companies and the most common benchmark to see whether people should feel good or bad about their investing. and we'll compare it to what we categorize as growth stocks and value stocks. And 96 and 94%, that doesn't do much. So what if we add mid-sized companies and small-sized companies? It's a little better, but still not meaningful. But foreign stocks. Everyone knows it's important to own a mix of U.S. and foreign stocks. But if that's true, then we should expect a big difference between ExxonMobil stock, for example, and say Royal Dutch Shell, simply because their headquarters are in different countries. And doesn't that seem a little ridiculous? If we fill in the foreign stock correlations for all these stock types, the numbers seem to agree that where a company's headquarters is located doesn't really matter that much, at least for global companies. In fact, let me fill in the rest of this chart, and you can see why we tend to view these stock types like different colors of M&Ms. There's no real difference. I can add high yield bonds to the mix, and that does practically nothing. Now this chart is straight from Morningstar, which had a big role in defining these stock types, and not a single category has had any meaningful diversification over the last 5 years. And that's true for the 3, 7, and 10-year numbers as well. So this is why it often feels like we butt heads with other advisors who think owning a small cap fund and a mid cap fund is actually doing something. At least we have bonds though. But remember that 0% is the ideal number, not 54%. The correlation between stocks and bonds has gotten higher because what the Fed does with interest rates is the overwhelming driver for stock prices right now, and the same Federal Reserve policies that help stocks also help bonds. If we want to beat a specific return with high reliability, the investments have to be different. But first we need to figure out what the return target is, whether it's reasonable, how much risk it might take to achieve it, and this is determined by a wealth plan. So what's different about a wealth plan than, say, an investment plan or a generic financial plan? A wealth plan is really a long-term financial model that takes into account all sources of income over time, estimates and attempts to avoid unnecessary taxes. Some taxes are necessary, but we try to minimize and plan for them. Figures out medical expenses, estate planning, on and on. And ultimately, it determines what the portfolio needs to do. As an example of the difference, if you're only trying to maximize return, you really can't pay attention to taxes because the taxes you pay never shows up on a performance chart. A wealth plan is trying to maximize wealth, not necessarily just raw investment performance. So if we want to beat a specific return target, we can't rely on investor emotions to determine our return. We have to invest our money into something that has a known return with risk that can be measured and at least somewhat controlled. How do we do that? Well, risk is kind of like energy. You can't get rid of it, but you can change its form. So in some cases, we can design an investment that reduces the risk of losing money and exchanges it for the risk of missing out if the market goes up higher than our target return. And that all sounds great in theory, and it turns out we implemented an investment recently that I think is a perfect example of what I'm talking about here. I use the term magic here because many people and a lot of advisors don't know these investments exist. But there really is no such thing as magic money. These investments have to make sense for everyone involved. Some investment advisors will talk about hitting a specific return, but then they use the same investments that everybody else uses. So I wanted to show you an actual example of an investment that we used recently that's materially different. It's called a structured note, and it was issued through Goldman Sachs. We have the ability to initiate custom investments through most of the big global banks. And I would consider this to be a growth investment because it doesn't provide regular income like some structured notes. It just gives you a lump sum at the end, and so it can be taxed as long-term capital gain. Really, it's just a loan to Goldman Sachs, much like a bond. Bonds are publicly traded where structured notes are not, although they can be redeemed back to the bank at any time. And they're senior notes in that if something happened to the bank would have to default on all of their bonds first before a senior note got touched. Even when Lehman Brothers went under, their senior notes didn't default. This particular note uses a stock bond combination index that's really tailored more for annuities. It's designed to have slow and steady growth with very limited volatility. So we initiated this on May 31st, and the note will wait a year plus a couple of days so that it could be taxed as long-term capital gain. And then it will ask, is the index positive by any amount? If the index is positive, the note gets called or redeemed for full price. We get all of our money back. 10% lump sum return, and the note is all done. If the index is negative, then the note will start checking at 6-month intervals. So the next interval would be December 1st, 2025. Is the index positive? If it is, that 10% snowballs and becomes 15%, and the note would be done at that point. If it's still negative, then we go for another 6 months, which would be June 1st. And if it gets called then, we would make 20%. So on and on, as long as that index continues to be negative, it will just keep checking every 6 months. And I draw the line here at 3 years because no note of this type has made it past 3 years. 80% of them are called after 1 year. Only one of them's made it to 3 years. But if the market was really bad and was still negative, then this note would continue checking every 6 months for up to 7 years. So in 2031 would be its last checkpoint. At that point, if the index finally went positive, we would have accumulated 70% by that time. But what if the index was still negative, which would imply that the market's been going down for 7 years? At that point, we would simply get all of our money back. Now, there might be a temptation to think, well, then you've wasted 7 years. But if the alternative was investing in a stock fund, we'd probably be happy getting all of our money back. So we've truly substituted the risk of loss and exchanged it for the risk of missing out if the market goes up more than 10%. So let's see how this would look over the last 10 years on a stock chart. It's been a very good time for stocks, and you can see this momentum builder stock index is just slow and boring. If you compare it to the S&P 500, much more excitement, much better return. Again, I don't expect the next 10 years to look anything like the last 10 years, but this is what happened. If you look at 2022, the S&P was down a little more than 18%, and the Momentum Builder Index was down less than 3%. So it's just slow, boring. It will never be exciting. However, if we design a note with it and we can make 10% on the note consistently, a 10% return becomes exciting again, and with no market risk. So this is why these types of investments, structured notes, are very popular with pension funds and college endowments, where they have to make a specific return, but they don't ever want to have much loss. It's very similar to most retirement portfolios. To close this out, I just have a couple of questions that we can ponder. Why are we investing our hard-earned money and putting it at risk? Are we attempting to change our life? Do we just want to protect savings and grow it at a reasonable rate? For some people that are in retirement, do we want to generate a paycheck? So rather than being forced to sell things, can we generate enough income to replace our paycheck? Once we start thinking down these lines, though, the risk discussion becomes very different. And instead of having a risk discussion that's around how would you feel if your portfolio was down 25%, we can now have a risk discussion of how much of the nest egg should be dedicated to maximizing returns versus making sure we're financially successful. And in reality, for most of us, it's a combination of the two. Is there an element of entertainment in investing? For me, there certainly is, and there's absolutely nothing wrong with investing as a form of entertainment. So a lot of people, when they think about going for boring investments that just give you 10%, are thinking, well, I don't want to lose the excitement of investing myself. This is where you can start thinking about, is there a portion of a portfolio or a portion of a nest egg that should be dedicated to just achieving goals? If let's say that's 90% or 80%, could be whatever. Let's say it's 90%. And that will achieve your goals with high reliability. That then frees you up to take the remainder and take as much risk as you want, because it's not going to put your long-term financial life in danger. All right, we'll leave it with that. Thank you very much for listening to this. Hope it was at least somewhat interesting.